When it comes to standard deduction and tax credits in the context of US taxation, many people think that they are the same. They don't have any differences. But in reality, there's a difference. Well, ultimately both lead to reduce your tax, but there's a difference in the treatment and there's a difference in the concept. So today we will have a discussion on this topic in this short video. You're watching Tech, Tax and More with SM. We are moving towards to the topic again. So standard deduction is a deduction that reduces your total taxable income, and it depends on your filing status. Like in the US, when we talk about the US taxation, there are different filing status, like it's single, married, head of household, and different more some more status as well. So standard deduction, basically what it do is that it reduces your total taxable income. Let's say if I talk about an example, right? Let's say Mr. A has an income of $50,000 annually. Now, uh, let's give an example. The standard deduction for single, if the filing status is single, the standard deduction is $13,850. So let's say Mr. A has a total income of 50,000. So what the standard deduction will do now is that Mr. A will subtract this 13,850 from this income, and then he will pay the remaining amount as a taxable income. So what the standard deduction is doing, that it reducing your total taxable income. But when we talk about the tax credits, the tax credit does not reduces your total taxable income, but it reduces your tax, the actual tax that you are gonna pay. It does not affect your income, but it affects your tax. So let's say, okay, when we talk about the tax credits, there are two types of tax credits. One is the refundable tax credits. Another one is the non-refundable tax credits. The refundable tax credits are those that if your refund is there, it reduces your tax and there's a refund. In ultimately, if there's a refund, you will get the refund of that tax credit. But the non-refundable tax credit are those tax credits which you are not gonna get the refund. Now I'm giving an example here. Let's just understand this by taking example. Let's say uh, Mr. A again. So Mr. A has, let's say Mr. A uh, has a tax of $1,000, right? Mr. A has a tax of $1,000, and now he has a child tax credit. Let's say the total child tax credit for the year, I'm just giving an example, is 500. So now what he will do is he will subtract this from this, and that is the liability that he's gonna pay to the IRS department, the revenue department of USA. So a child tax credit is a refundable tax credit, and let's say now let's take another example. If there's a tax of $1,000 and the tax credit, let's say the example, let's just talking about example, the child tax credit is $1,200. Now what will happen is that he will get the refund of $200. So if it's a refundable tax credit, he will get the refund of this. But if it's not a refundable, he will not get the refund of that. But ultimately, the liability will be zero. So to summarize it, the standard deduction lowers your taxable income depending on the filing status when you are filing your tax return, whereas the tax credit is a credits that will reduce your total tax for the year. I hope you like this video. If you have any questions, if you have any comments, do let me know in the comment box. Thank you very much.